Savings Bonds Debt Management Office DMO announces 2023 first offer. Investments and Securities Bill to transform capital market boost investors' confidence. World Bank says Central Bank of Nigeria loan repayments to gulp 62% of revenue, plus one-third of global economy to face recession in 2023 rather, says the IMF. The program is Business Express reaching you from Abuja, Nigeria's capital, on this very first episode of the year 2023. The President is signing the 2023 budget at 10 a.m. It is 30 minutes away, so stay tuned on the network service of the NTA because we are bringing it to you live. I am Leah Katung Babatunde. You're welcome. The World Bank says interest payments on the federal government's borrowings from the central bank will gulp over 62% of revenue by the year 2027. The International Finance Organization made the projection in the latest edition of its Nigeria Development Update NDU titled Nigeria's Choice. The federal government has been borrowing from the CBN through Ways and Means Advances, a loan facility through which the CBN finances the government's budget shortfalls. In the report, the World Bank said interest repayments will increase by 2.4 percentage points of the GDP between 2018 and 2027. Managing Director of the International Monetary Fund, Kristalina Georgieva, has warned that one-third of the world economy is expected to enter recession this year. The IMF head said the resilient U.S. economy may help get the world through a very difficult year. She added that if the labor market in America holds despite the risk, she further noted that even for countries that are not in recession, it will feel like recession for hundreds of millions of people. And still with the global economy, it is projected to go into recession this year, 2023, just as inflation is said to continue to be a bottleneck to business growth around the world. Details with Musa Babaliu.
Growth forecast for this year is unchanged at 3.2%, while our projection for 2023 is lowered to 2.7%, 0.2 percentage points lower than the July forecast.
Yeah, that was, of course, put together by Musa Babaliu. The Debt Management Office, DMO, has announced its first bonds issuance for 2023. Two federal government bonds, saving bonds for subscription. A statement by the DMO says one is a 2-year FGN savings bond due January 11, 2025 at the interest rate of 9.6% per annum. The other is a 3-year FGN savings bond due in January 11, 2026 at the interest rate of 10.6% per annum. The DMO said that the opening date will be January 3, while the closing date will be January 6 and settlement date January 11, while coupon payment dates will be April 11, July 11, October 11 and January 11. They are offered at 1,000 Naira per unit subject to minimum subscription of 5,000 Naira and in multiples of 1,000 Naira thereafter subject to a maximum subscription of 50 million Naira. The Investments and Securities Bill, ISB, has been described as capable of transforming the capital market, encouraging the influx of foreign investors, as well as boosting investors' confidence, among others. Chairman of the House Committee on Capital Markets and Institutions, Babangida Ibrahim, stated these while commenting on the recent passage of the bill by the House of Representatives. He said the ISA bill seeks to repeal the existing Investments and Securities Act 2007 to establish a new market infrastructure and wide-ranging system of regulation of investments and securities businesses in Nigeria, especially in the areas of derivatives, systematic risk management, financial market infrastructure, and Ponzi schemes and platforms. Other areas the bill addresses are alternative trading systems, the inclusion of the National Pension Commission as part of the board of the Securities and Exchange Commission, the deletion of the provision on merger control in the current act, and the amendment of the criteria of borrowings by subnationals, and strengthening and enforcement of powers by the Securities and Exchange Commission in line with the requirements of the International Organization of Securities Commission, IOSCO. Now, how much is the naira exchanging for other currencies? Let's find out. Let's now take a trip to the commodities market. Well, a little more details from the energy market, where oil prices slid on Tuesday from their highest levels in a month on a stronger dollar, and after the head of the International Monetary Fund warned of a tougher 2023 as major economies experience weakening activity. Brent crude futures dropped 98 cents to $84.93 a barrel, while U.S. West Texas Intermediate crude was sold at $79.49 a barrel, down 77 cents. We're back home, and the Nigerian stock market in the year 2022 outperformed expectations after a late year sojourn in negative territory. The last days of the year, however, saw investors galloping away with gains, even as dividend payments to shareholders hit a whopping 1.1 trillion naira. The market in the course of the year also witnessed an increase in domestic participation. It is the first trading day of the year 2023. And I have joining me Professor of Capital Market Uche Walike of the Nasarawa State University, and he's joining me to take a look at market performance last year and what this year has for investors and the economy. You're welcome, Prof, to Business Express, and Happy New Year.
Thank you so much, Leah. Happy New Year.
Hope you had fun this holiday.
Yeah, we thank God.
Okay, great. A 19.98% rise is what we saw, and this is coming from 6.07% to be precise in 2021. So when we look at this, are we going to, can we conclude rather and say post-COVID recovery was achieved?
Yeah, I think that's quite remarkable. Just as you said, rightly noted, it beat expectations at 19.98%. That's around 20%. Compare that to 6.7% in 2021. And if you look at the average for emerging markets, as captured by the Morgan Stanley Capital MSCI for emerging markets, it's in the negative territory. The average for emerging markets is actually minus 18%,
wow.
for 2022. And even for developed economies, the average, again, if you look at the MSCI for world, that's developed markets, where you have about 23 markets. For emerging markets, captures about 24, markets. Okay. Even for developed markets, you also have a negative performance of minus 14%. So what that tells you is that our market, really, did well last year. And it also tells you the extent of resilience, that we have in that market. Remember too that the first half of the year, witnessed, a real strong momentum, strong investor sentiment. The first half gained 21.3%. Okay, although we saw a decline in the third quarter. First two quarters were okay. The third quarter recorded a decline of around 5.39%. And that was on the back of the monetary policy tightening that the central bank introduced. Recall that in May, the central bank began this, if you like, the hawkish monetary policy stance. And between May and November, we have seen a 500 basis point rise in the MPR, monetary policy rate. So all of that impacted the third quarter, such that in the third quarter, the market actually fell by, as I said, 5.39%. But we saw a resurgence in November. In the month of November alone, the market gained over 8%. And the momentum continued in December. Well, you can even rightly say that this year witnessed, the Santa Claus rally. Santa Claus rally, reflecting the returns that are usually earned in the market in the last trading days of December. So November and December, did very well, and such that you now have a yearly performance of nearly 20% return, to investors. So I think that's remarkable. And as I said, part of what made that possible, of course, has to do in the first quarter, in the first and second quarters of the year, first half of the year, you could attribute that to the strong oil price, international crude oil price. It was evident because the oil and gas sector, recorded the highest performance of over 34%. We are talking about an average. When we say the market recorded 19.98, it's just the average, the all share index, the average. Okay, you have 134 companies on the main board. You have 8 companies on the premium board. So when you take the average, okay, that's where you have 19.98. But if you disaggregate that, oil and gas sector, recorded over 34%. And I said, all of that, much of that came in the first half of the year because of strong oil price. Remember, oil price averaged over $100 per barrel within that period. Then, what drove, in my view, what we saw between November and December, corporate earnings. A lot of companies, reported good earnings, and of course, investors who want to take advantage of all that, by investing in stocks they believe that are undervalued, have good valuations. So that's what drove that. Another thing that may have, I'm saying may have because it hasn't been established, we have not done any study to establish that, is perhaps the central bank's currency rate design. Okay, it was announced in late October, and then we started seeing the surge in the stock market in November, which continued in December. So it's possible that the currency redesign is also having a favorable impact on the stock market, because there's liquidity, and part of that liquidity, money is coming out. Part of that may be triggering into the stock market. So that may have explained it. As I said, the surge, because that's the word, that's the way to describe that. But the truth of the matter is that all said, our market is resilient. The Nigerian stock market is quite resilient. This has proven it. In 2020, recall, when we had COVID, the world was bleeding. Okay, there was even a recession in 2020. But what happened? The stock market performed the best globally. Posted over 50% return. So that tells you that the people should have confidence in the Nigerian stock market. And you also noted it. What is happening now? Foreign investors are leaving.
I was going to ask you if the domestic investors are the ones driving this market.
We are the ones owning the market. This is our thing. So you have domestic investors now playing more in the market. Foreign investors are now exiting for obvious reasons. You have in the US, for example, you have the Federal Reserve tightening rates, also increasing rates there, leading to capital flow reversals in the US. Okay, and you also find the insecurity and some other challenges, making them leave. But domestic investors have not lost confidence in this economy, and that is why they are playing actively, particularly institutional investors, and to a large extent in November, retail investors also. I think it's October, because I saw the November report. That's the latest you see on the NGS website. Okay, November report of the domestic and foreign portfolio participation. Domestic investors are dominating by over 70%.
Oh wow!
Yes, and that's
remarkable.
That's good. Unlike before, prior to 2020, it was more of foreign investors. We are more or less tied to the upfront
every
string.
time they leave, it becomes a problem.
So we usually had that challenge, but now I think we have risen to the challenge. Nigerians are now, recognizing that this economy, belongs to us. Yes, we need foreign investors, but we also need to, participate, and that's what's happening.
1.1 trillion was paid out in dividends.
Yes.
Is it something new, and what does that imply for an economy like ours that is already recording an overall slow growth?
Yes, returns from the markets, come in two forms. You have capital appreciation. If you buy stocks today and it appreciates, you gain when you sell. Okay. Another way that you can also have return is via dividends. Okay. So that's why when we say shareholders' wealth is a combination of the dividend and the capital appreciation. So the fact that companies are paying dividends, many companies are paying dividends, is also telling you that that also goes to lend credence to what I talked about, market resilience, and the fact that investors too participated in the market or invested in the market, on the basis of the dividends that have been paid. When companies pay dividend, when you want to invest, for example, one of the things you'll be looking at is whether the company, has a track record of dividend payments. That's why I say one, stream of return is dividend. So if a company has a track record of paying dividend, it gives you the confidence to also invest. So part of why we saw the increase, particularly in the NGX banking. NGX banking didn't do well in the first half of the year, but this last quarter, picked up. The NGX premium board, where you have the likes of the Dangotes, the Bua Cement, the MTNs, okay?
The big guys.
Yes. The industrial, again, the Dangote. So because of the track record of dividend payment, investors, are looking at them as being undervalued. Undervalued means you are saying that this stock has potential. The value that it is currently having, okay, is not what it should be. It has potential of going. And when you have that perception that the stock price is likely to rise, you want to buy now. So that is what has played out. So it's a good sign. Yes, when companies make earnings and pay dividend, it's also a good sign that the companies themselves are sound. Okay,
yeah.
That doesn't mean that if a company doesn't pay dividend, it's not sound. We know.
Yes,
that
I wanted to take you actually on that.
Yes.
How, for the sake of our viewers now, how does one know or trace a company that pays dividends?
From their records. I said a company that has a track record of dividend payment. Yes, if you look at a 5-year story of a company, say company A, and company A has consistently paid dividends in the last 5 years, it means that there is every likelihood that that company will pay dividend this year. Okay, but if a company doesn't have that track record, again, it puts you off. But when a company has not paid dividend, but the company's share price is rising, you can also, on the basis of that, invest. Because what usually happens is some companies may identify some investment opportunities. What we say identifying projects with positive net present value. So even when you have made earnings and you're supposed to pay dividend, but because you have a project you want to do that will bring in more money for shareholders, you let the shareholders know about that. You're not paying them dividend, you want to put that money somewhere, and when you put that money in that project, what usually happens is that the share price of that company will appreciate. So any shareholder who has not received dividend from you, who is pressed for cash and wants to get some money, can easily sell part of his shares, and if as they say, pay himself or herself dividend. So we call that homemade dividend, in finance. So what is important is that the bottom line is earnings. Companies should be able to have earnings, and earnings, of course, we know they are a function of the macro environment. If the macro environment is good, is stable, companies are likely to have huge earnings, and that is why we always pray, we always wish that the economy is right, because if the economy is having challenges, it may affect the performance of companies. But as I said earlier on, the fact that our companies are still having their heads above water despite the challenges, tells you that we have a resilient, economy.
Okay. I want to take you back again to the policies. Of course, this is an election year. We've seen multiple policies from the monetary side. On the fiscal side, the budget is about being signed by the president. It is going to be accompanied by the Finance Act,
yes,
which, of course, notably, we're going to see some increases in taxes and some other changes here and there.
Yes.
How will these be affecting the capital market this year?
Oh yes, it's as if you read my recent article on the outlook for the market in 2022. It's just been published, where I identify the factors that will influence the stock market returns or stock market performance in 2023. One of them is, of course, what you have mentioned, the general elections. The general elections will certainly affect the stock market performance, again depending on how it pans out. Okay, so if at the end of the day it's seen as largely credible, and it turns out well, then you should expect that will also boost investors' confidence. Foreign investors will come. Right now, a lot of investors are sitting on the fence, particularly foreign investors, who don't want to come because of the uncertainties, surrounding the general election. So once the general election is over, and as I said, it's peaceful, it's credible, particularly adjudged credible by the international community, that will see some flows into the market. So that's one. The other one is also what you mentioned, the budget. The budget, as you know, is an expansionary one. 21.8 trillion. That's what we have now. I'm sure that's what the president will be signing. The new the bill.
Yeah,
Okay,
I think
so
it is just going to be a nice point in this program to inform our viewers that the budget signing will be 10 on the dot. The clock is ticking, and this is an extended discussion, of course. We would bring that live transmission to you in less than 5, and we're here with Professor Uchewaleke. Thank you so much.
Yeah, thank you. Yes, I was saying the budget, the outcome of the budget will certainly affect the stock market performance, in the sense that the budget, as you know, is hugely weighted in favor of recurrence, one, and the budget is also going to be financed largely by the deficit, borrowing, and much of that is going to be done via domestic borrowing. And as government borrows, what usually happens is that interest rates are driven up. Okay, the more the government is borrowing, the more the private sector is crowded out, the more there's competition for the funds available. So interest rates, are going up, and that's also now take that side by side with what the monetary authority is also doing. The central bank is tightening monetary policy, increasing the MPR because of what? Rising inflation. Okay, central bank wants to tame inflation, but that's also driving up interest rates. So you have a high interest rate environment. Where you have a high interest rate environment and you also have high inflation rates, these are twin headwinds that don't impact the market, in any favorable way. Because as an investor, for example, you'll be looking at the inflation rate. Right now, we are just celebrating that the market had 19.9%, but that's still below inflation rate.
Yes.
Inflation rates are 21.47.
So what does that mean?
For November.
What does that mean?
That means that the return that you have as an investor in the market is still a negative return.
Oh. In
real terms. So your real rate of return is still negative. So your return needs to stay above inflation rate for it to be positive.
So it's still not a good news.
Yes, it's still but it's still not good because of the effect of inflation. And look at where exchange rate is. So you're looking at exchange rate, you're looking at inflation rate. So for you to have anything that is meaningful, you should be talking about maybe returns in excess of 30-40%. And that is why this kind of environment now creates opportunities for the booming of Ponzi schemes. You know Ponzi scheme?
Yeah.
Yes, when somebody comes to tell you, you put your money here, you get 40%, you get 50%.
It just grows like grass.
Because those returns are higher than inflation rate. You want to fall for them. Because the ones that appear legitimate are not fetching you, the returns that will make you stay above inflation rate.
So a warning sign is when the returns are above inflation rate, just run away.
Exactly. And then when interest rates are also high, what usually happens is that you find many investors, fund managers, portfolio managers, they will now rebalance their portfolio. If they put some money in equities, they will move them from equities to bonds. Because bonds, the yields are rising. When government is borrowing, government is issuing bond. Okay? So when interest rates are going up, those bond yields are rising, meaning their prices are falling. So if bond yields are going up, investors, fund managers who want to now invest in the fixed income market, fixed income space, where you have bonds, where you have treasury bills, because their interest rates will rise. So equities market will be tanking. So high interest rate, high inflation rate, they are not good for the equities market. So I'm saying that the budget will affect, implementation of the budget will affect that to the extent that it has the potential to raise, interest rates on the fiscal side. The monetary side too, see what the central bank is also doing to tame inflation. That's their job. Okay, but in taming inflation, as I said, there's a trade-off. Interest rate is also going up. Cost of fund is going up. Businesses cannot access credit, at cheap funds. And look at what we are also going to witness. The government is thinking of securitizing all the loans that the central bank, have given the government over time. So
Okay.
All of that will result in a high interest rate environment.
Okay, Prof. We are joining the President live at the Presidential Villa for the signing of the 2023 budget. We will be back.
To serve with